Welcome back. And we have now the session titled The Science Behind Social Investing. Our guest is Dr. Daniel Crosby, who is the Chief Behavioral Officer at Orion Advisor Solutions. And we have our own Callie Cox back again. In case you have forgotten, she is the Senior Investment Strategist with Ally Invest. Hello, Callie and Daniel.
Hello, hey, Brian. Hey. Well, we are so excited to be here today. And wow, we have some tough acts to follow, Daniel. Big round of applause, definitely, to our Ally thought leaders in Ari and Simone. They've been crushing it so far, and I've been learning so much. All right, so today we're going to explore the science and psychology around social investing. Now, when I say social investing, I mean coordinated trend following in markets off of social media. And yes, that means I'm referring to what we've seen in meme stocks and crypto, among other things. Now, for a little bit of background, social investing has existed for decades through social media, as it has today, and online forums, as it did during the tech bubble, for instance. But today, it's become the topic of conversation in markets. I mean, I can't go a day without somebody asking me about meme stocks. And Dr. Daniel Crosby, who we have with us today, has some fascinating thoughts on why your brain has played such a big role in the social investing movement, plus how investing has become part of our lifestyles and identities. Fascinating stuff. All right, but before we kick these things off, I've got a question for all of you viewers. Have you traded a meme stock this year? Go to ally.com/live poll and let us know. That is ally.com/live poll. And we will check out the answer in just a minute. I'm really interested to see what pops up here. All right, Dan, tell us a little bit about yourself and why you're qualified to speak about social investing.
Thanks, Callie. It's great to be here with you all today. So I am a doctor of psychology. My PhD is in clinical psychology, but I've spent my entire career in the financial markets. The New York Times bestselling author of a few books on the topic of market psychology, including The Laws of Wealth and The Behavioral Investor. So this is what I do all the time, study how people make financial decisions, study how our brains and our bodies are wired to help conspire to make good or bad decisions. And so I'm excited to be here with you today to talk about this meme stock movement.
Awesome. Well, we're so excited to have you, Daniel. We're going to have a good conversation. All right. So I'm looking to my left right now. Let's see what we're working with today, Daniel. Let's see what the poll question is saying. So how many of you have traded meme stocks this year? All right. So this is interesting. About 38% of you say, what's that? Perfect. Well, we're going to break it down for you. I'm seeing 34% no, and then about 30% yes. So pretty evenly split, actually. What do you think about that, Dan? Surprised?
Yeah, I'm a little surprised. I'm a little surprised it's not higher. I know that you at Ally have some interesting intel on just what percentage of stocks being traded were meme stocks. I know that at a couple of points this year, AMC and GameStop, some of the biggest, most prominent meme stocks, were actually traded more than the S&P 500. Pretty unprecedented. So sounds like we got about a third diamond hands, about a third who aren't into it, and a third who have questions. So should be a great crowd.
Yeah, for sure. And fun fact from our platform, at the height of the GameStop short squeeze, about 25% of our clients were buying and selling meme stocks, which is crazy to think about because in an average month this year, about 28% of our clients actually trade. That is, buy or sell stocks at least once a month. So the meme stocks really took over. And, honestly, that's not a bad thing, but we'll get into that a little bit later. So I'll back up for a second. So when I say meme stocks, I'm talking about the GameStops, the AMCs, the Nokias, the BlackBerries of the world. The stocks that have become popular because they have become popular on social media. And there's really been a strong movement behind that. It really popped up in January. A lot of these stocks have soared to incredible highs that nobody would expect. And it's just been a fascinating story. So that's the 101. But I'm going to back up just a little bit. Dan, I want you to tell us, why does psychology matter so much in investing?
Well, psychology is really beneath everything we do in investing. And when you look at investment outcomes, most people think, the difference between those who are successful and those who are unsuccessful is going to be something like, the level of due diligence that they do, or the amount of financial acumen that they have, or their experience in capital markets. But we find again and again that those who outperform don't do so on the basis of their knowledge, but rather on the basis of their temperament. And Warren Buffett has even talked about this, how IQ and how knowledge are secondary to things like being even keeled, being temperate, being moderate. So psychology really does underlie everything we do in financial markets. And interestingly, it explains a lot of what's been going on with these meme stocks. Things like brain science can help us understand why we are so drawn to these mimetic trends. And so I think it's an understudied but powerful piece of why we do what we do in financial markets.
Yeah, for sure, Dan. Investing is definitely a mind game. I remember starting out on my investing journey and thinking, what am I going to buy? What am I going to sell? And then I actually read The Psychology of Money by Morgan Housel, and it just completely blew my mind. And for everybody, that's a great book. It's just basically about how to think about investing. And it talks about how your emotions and how your needs kind of work into that. And I'm a big behavioral finance believer. It's all up here. For sure. All right. So with that being said, Dan, tell us about some popular behavioral biases that investors struggle with. I mean, what are we working with here?
Okay, so good news, bad news here. The bad news is there are over 200 now. That psychologists like myself have identified 200 ways that you can make poor financial decisions. But what I've done in my research is I've actually drilled down that 200 into a more workable universe of 4. And so the good news is there's really about 4 primary things that we do and 4 primary ways that we can make errors in financial markets. And if we can understand those things about ourselves and we can build processes around them that keep us from falling into those 4 traps, we'll be in a good place. So really quickly, those 4 are ego, which is our tendency to be sort of overconfident, to think that we're smarter, better, faster, luckier than the next person. The second one is emotion, right? So emotion is this tendency to let our heart rule our head when making financial decisions and just sort of getting overly emotional about our choices. The third one is attention. I call this confusing what's loud with what is likely. There's a famous study that I love that shows that more people die every year from taking selfies than from shark attacks. But we know that the average person is much more scared of going into the ocean than they are taking a selfie because shark attacks are louder, right? They're more salient, they're more visceral, they're easier to imagine. And so a lot of times we confuse what's loud with what's likely. And then the final piece is conservatism, which is our tendency to want to stick with what we know and play it safe. So behavioral finance has taught us that we are about 2.5 times as upset about a loss as we are happy about a comparably sized gain. And so this can lead people to play it too safe, to sit in cash, and to not participate in markets in the way that they should. So those are the big 4. If you can overcome those and be aware of your tendencies to play into those 4, you'll be in a good place.
Awesome. Okay, so we have a little base established here of behavioral biases. So connect the dots for us, Dan. How have these biases popped up in today's market environment?
Okay, so let's take ego, for instance, right? So this is this belief that we're smarter, better, and luckier than the next person. I think if you asked the average person, should you day trade? Should you buy and should you buy and sell stocks rapidly? I think even people with limited knowledge of how markets work would say no. But ego leads us to believe that this time is different, or that we are different, and that we won't be susceptible to some of the same traps as the next person. So you see that, right? We see across 19 different countries that we've studied, the more moves someone makes in a portfolio, right? The more they buy and sell, the worse that they tend to do. That has played out across every single country that we've ever studied. And yet people, because of this ego, think this doesn't apply to me, or this is different, this meme stock is different, this time is different. And it sort of causes us to be a stranger to our rules, or to think that the rules don't apply to us. The second piece is emotion. You think about the emotional place that we are in as a nation and as a world. I'm a psychologist. I keep close tabs on sort of the mental health milieu, even though I don't work in that environment anymore. And in Atlanta, where I live, calls to crisis lines were up 425% over the last year. So all of us, not all of us, many of us have been in a bad emotional state. We've been lonely, we've been fearful, we've been disconnected. And you're seeing some of that emotion leak out into the financial markets, and people are making emotionally driven decisions. And then finally, you think about that attention, right? Confusing what's loud with what's likely. The news around these meme stocks has been very, very loud. I have a 7-year-old son, right? So I have a 7-year-old son, and I told him I was doing this event today. And I said, it's all about meme stocks. And my 7-year-old son said, like GameStop and Dogecoin, right? A 7-year-old, this has been so loud. This has been so in our face that even little kids have heard about this. And so it's been very emotional. It's occurred across an emotional backdrop. It's been very in our faces, and we've suffered from some overconfidence. So all of these things are playing into the rise and the rapidity with which all this goes down.
Wow, that's incredible. Your son asked you, wow. Okay, story time on my end. A few weeks ago, my mom came to visit me in Charlotte. That's where we're based. And my mom asked me about Dogecoin. And if you know my mom should not know about Dogecoin. I mean, she barely knows like what's going on during the day. She doesn't use a phone. And when I heard that, I was like, whoa, Mom, whoa, this is super mainstream. So, I mean, it's definitely a thing. It's the big conversation of society. And it's intriguing in that I feel like it's two worlds meshing. It's like Wall Street's meshing with everything else, which is intriguing and honestly great. I mean, everybody should feel entitled and able to invest. But I'll put a pin in that for a second because I want to hear too. Give us some tips on how to overcome these biases, Dan. You've told us about what all is going on. Tell us about how to solve them.
Yeah, if I only had a couple of pieces of advice to give people, the first thing I would tell you to do, there's really three things that you need. The first thing is education. There's 3 E's, right? The first E is education. You need to know how markets work. Now, the meme stock thing has been a little bit of a blessing and a curse relative to education, because on the one hand, many new market participants have entered the fray as a result of these things being so in the news. And that's great news. And many of the people who have entered into investing during this time have been atypical of those who have historically been invested. So we're reaching out, we're reaching new audiences, we're reaching more diverse audiences, younger audiences. That's nothing but a good thing, right? And there's a lot to be learned. I've learned a ton about shorting stocks and short squeezes. And I mean, I do this for a living, and I've learned a great deal by following these meme stocks. So the first piece is education, right? We need to know how markets work. So getting involved in meme stocks can potentially give us somewhat of an education if we approach it in a diversified and sort of a safe, limited way. But I'm also fearful that some people are learning the wrong lessons, right? Because, some of these stocks have doubled and tripled in just a space of 2 or 3 days and then have dropped 80% in the next day or two. Typically, markets are neither that good nor that bad. And so I think people need to learn to educate themselves on how markets work, how buying and selling works, how shorting and all of this works. And that's a powerful first step. The second thing we need is the right environment. So the right environment is the right portfolio mix, the right mix of assets. This is going to include things that might be risky and more speculative, but it's also going to include some ballast, some safer things that keep your portfolio safe when times are not so great. So getting the right environment is absolutely crucial. The right mix of assets, the right blend of diversification is that second piece. And the third E is encouragement. Because even the smartest person, even the savviest market participant is going to come up against their own psychology from time to time, their own greed, their own fear, their own panic. And at times like that, it's really important that you have someone in your corner, right? This is a professional, a coach, a financial advisor. The research shows again and again that people who work with financial professionals outperform those who don't. And it's not because the financial professionals are necessarily putting them in the hottest stocks or the hottest asset classes. It's because the financial professionals are keeping them from blowing themselves up or making that emotional decision. So get that education, right? Get the right environment, the right mix of assets, and get that right encouragement in the form of someone to help walk that path with you in the form of a coach or an advisor.
Yeah, for sure. I love all of that, Dan. And I'll say too, I mean, education, I agree with you that the meme stocks phenomenon is a blessing and a curse. I know a lot of people like to, view it kind of pejoratively and say like, oh, this is just how markets are changing. Like they don't know what's going on. But it really is. I mean, if your goal is widening the tent and showing people that they can invest, I mean, this has been one of the best events in history for that. And we love seeing the fact that, our customers are getting in and trying to like trade or even, investing, opening an account and investing, because sometimes, the best lesson you can learn is losing. And there are winners and losers. You might have been a winner, but, experience is the best test. And you really don't know how you'll invest and, what you'll invest in, how to go about that until you actually try. So we've loved being able to see that. All right, I'm going to go a little off script, Dan. I hope you don't get mad at me, but I want you to tell us a little. I want you to tell us a little bit about your money story. Tell us about how you started working in the field of finance and wealth, and how you started investing personally.
Yeah, so my dad is a financial advisor. So I think unlike most Americans, I grew up in a home where money was very freely discussed. And in my particular home, my dad had a rule that debt was a 4-letter word. I grew up in sort of a conservative home. We couldn't swear or anything like that, of course. And so debt was literally considered a 4-letter word like the rest of the 4-letter words. And so money was very much on the table at my house. I remember sitting around the table talking about investing during elementary school and stuff in the stock market game. I always did well because I had my dad in my corner. And so I grew up in a little bit of an unusual place, sort of steeped in talking about markets and finance. In college, I fell in love with psychology, even though I had entered college to ostensibly become an investment advisor or a financial professional. I fell in love with psychology during some of my general ed classes. And then somewhere along the path in grad school, realized that there was a ton of psychology in financial markets and that I could blend my two loves. Because even though my degree's in clinical psychology, I wasn't great at it. And I really wanted to think about why people do the things that they do against a backdrop that gave me some immediate feedback. And the market certainly does that. So my money story is one about, growing up in a home where money was very much discussed, but sort of discovering over time how much psychology there was in this whole world and understanding how central that was. Because I think as a child and even as a young man, I thought that it was all about the numbers. I remember even coming to my dad and saying, I'd love to do something with markets, but I'm really more of a psych guy. And him saying, look, my work is full of psychology, and thinking, what? I thought you crunched numbers. I thought this was all about analysis. And understanding that the blend of mind and markets is really the way to be successful has been so enriching for me. And so I hope that's something the listeners can take that even if you don't love crunching numbers, even if you're a little more right-brained, a little more artistic, a little more creative, there's room for you in the world of finance, and there's room for you to be successful if you can study and control your own temperament and your own reactions.
Absolutely. This creative over here, I mean, my heart is just singing. I agree. There's room for everybody in the tent here. All right, so that's Daniel Crosby, the doctor. Now you know his money story. So let's talk a little bit about meme stocks. So Dan, I want you to rewind your life back to when GameStop was first surging. You know, remember the days back in January. What were your initial thoughts as a behavioral finance expert? Like when you read the headlines, when you saw the markets, what were you thinking?
So my initial thought was what in the world? Because I have developed sort of my own screens for stocks. I look for stocks that are high quality, fairly priced, and have a little bit of a head of steam, right? So sort of value, quality, and momentum to use sort of the technical terms. So I'm always looking for stocks that meet these three criteria. And for many years, GameStop had been on my radar for like years in the past. It had passed sort of these screens, but it had always been kind of a dud, right? It had never really done very well, even though it screened well. And so when I saw it taking off, I was very confused because it had been on my radar for some time, and I had even historically been an investor, and I had not done very well with it. It had been kind of flat. And so I was intrigued when it took off. And then, of course, I started to look into the backdrop against which all this is happening. And so to set the table a little bit, we have all collectively just been through an unprecedented time of social isolation. And we've had this health crisis, but we've had an accompanying mental health crisis. And a lot of what has driven that mental health crisis has been loneliness, isolation, social disconnectedness. If you want one thing that is predictive of good mental health, you look at relationships, right? If you only had one variable, you look at the strength of someone's relationships, and that's going to tell you a ton about their emotional well-being. Well, that was sort of stripped from all of us in a very real way. And so what I started doing is that week I was up, I'm embarrassed to tell you, I was up till 2 or 3 every night reading those forums because it was so fascinating to me. And what I saw in those forums was real, real brotherhood and sisterhood, real people sort of united in a common cause. And the cause on paper was that they were going to, get rich, but do it in kind of a righteous way. The message was very much, we're going to stick together. We're going to make a bunch of money, and we're going to stick it to the sort of traditional Wall Street institutions and the hedge funds. This is sort of, right or wrong. This is sort of the message that's happening. And this message playing out against the backdrop of loneliness and social isolation, and at a time when we had freer access to trading and information than ever before, right? It was sort of the perfect storm. So people were looking for connection. People were financially insecure. They were looking for a way to make a buck. People's lives had been de-risked, right? Like all of our lives had been completely de-risked. We were all sort of hermetically sealed up in our own houses. Humankind has a desire to take risk, and there's certainly plenty of risk to be had in investing in meme stocks. So it was sort of this perfect storm of these de-risked lives that were lonely and sort of rudderless. And into this storm comes a group of people who are telling you, we can get rich, we can do it in a way that sticks it to the powers that be, and we can do this as a cohort. And it was just the right message at the right time.
Yeah, for sure. For sure. That's just riveting. I definitely did not think that deep, but that's why I'm not a behavioral finance scientist. But the whole phenomenon was just so fascinating, and just the psychological struggles behind it too, as unfortunate as they are coming from the COVID pandemic. So when you said that, Dan, it really struck me. We have this, yearning for community, this yearning to get out of this loneliness. Tell us a little bit about the importance of kind of finding your purpose and investing, and how community can be part of that purpose? You know how social investing kind of works into that.
Yeah, so you make a great point about starting with why. So my first finance book that was a book that was written all about goals-based investing. Now, goals-based investing is just what it sounds like. It's a very simple idea that has very powerful outcomes. Goals-based investing is really all about naming your dollars, just putting a name and a purpose on every dollar, and understanding that something called mental accounting kicks in. So mental accounting is our tendency to spend, save, invest money differently depending on how it's labeled, right? So we know that people who win in Vegas, right, they spend their winnings differently than they spend the money that they came with. If you enter a casino with $100 and you leave with 1,000, you spend the 900 of that house money, call it, very differently than you spend the 100 that you got at your job. We've even actually seen this in research done with criminals. There was fascinating research done with criminals that showed that, many of these criminals had a day job, right? And then they sort of had their night hustle, the illegal hustle. And so many of these criminals would tithe and give charitably and do things with their legitimate earnings that they would not do with their illegitimate earnings. They would spend those illegitimate earnings very differently than they did their legitimate earnings. So where does this apply to the average person, right? Naming our dollars, just saying, this is Callie's retirement fund versus this is Callie's, swim with the sea turtles with my husband fund. We spend those funds. People who name their dollars were 3 times less likely to panic and go to cash, and 2 times more likely to save. So I'll close with a final, one of my favorite studies of all time. I've got a couple of young kids, and in this study, they did a study with low wage earners, so people who were just barely scraping by, and they were trying to get these folks who had limited funds to save and invest for a rainy day, and they're having a hard time. They tried rewards, they tried punishments, nothing was working until they intervened. And what they did was they had these people look at a picture of their children for 5 seconds before they made any financial decision with their online sort of savings and checking account. And what they found is when people looked at a picture of their children for just 5 seconds before making a choice, they saved 200% more than those in a control group. So naming your dollars, putting a purpose on them, having a why attached to them can be very, very powerful. Now, there's a couple of caveats here. Not all whys are created equal. Some of the social investing that we've seen lately has candidly been about getting rich, right? And getting rich is not a sufficient motivator to keep people invested, because at the first sign of trouble, they go, I may not be getting rich, right? And this isn't sort of an adequate why to stay the course. But what really does work is what we'll call socially responsible investing. So people investing a lot alongside their values. Those could be religious values. They could be environmental values about sort of, green values. They could be social values, like making sure that a workforce has equal gender representation or is LGBT plus friendly. It could be governance issues that could be, is this a corporation that's run in an upright fashion? So what we find is that people who invest in a way that's consistent with their values, their religious, their ethical, their moral values, these people are much better behaved than people who are investing in sort of a let me just get rich quick sort of way. So naming your dollars can be very powerful. Having a goal, a carrot out in front of you can be very powerful. And investing in a manner that's consistent with your values can be very powerful, not only to change the world, but also to help keep you in your seat when times get difficult.
Yes, I love that. I love it. And yeah, completely agree. Knowing your why, I feel like everybody in finance throws that out. They're like, okay, before you invest, know your why. And you're like, come on, let me just put my money in a stock. But it's so important because knowing your why drives everything else you do when you're investing your money. It drives what you invest in, how long you invest in, what your motivation is when things get rough. It's so incredibly important. And shout out Allies Savings Buckets if you want to name your cash.
That's right.
I know. Yeah. I know Nicole shouted it out in the first panel, so I'll just give it a little bit of love too. All right, Dan. So we talked about finding your purpose. Tell us about what the meme stock phenomenon means for society. How do you think it'll change society? How has it already changed society?
So some of these things I think are very specific to the here and now, and some of them are enduring. Okay, I said earlier that an understanding of how your brain works is actually instrumental to understanding sort of this meme stock phenomenon. So let me say more about that. So your brain is pretty small, right? It accounts for 2 to 3% of your body weight. So on a relative basis, it's not very big, but it is extremely hungry. It accounts for somewhere in the neighborhood of 20 to 25% of your metabolic expenditure. So 20 to 25% of the calories you burn in a day are burned by your brain. And so because there's sort of this huge mismatch between the size of your brain and sort of the exertion of your brain, it's always looking for ways to coast. It's always looking for ways to go into sort of energy saver mode, if you will. And one of the most powerful ways that we can do that is by deferring to other people, by looking at other people and just sort of drafting off of their decisions the same way that a runner or a race car or a bicyclist might draft off of someone in front of them. Just, okay, I'll have what they're having, sort of thing. Now, this just is what it is. This is not going anywhere. You couldn't be different if you tried. We're all social creatures, but we have to ask ourselves, are we surrounding ourselves with the right social inputs, right? Are we surrounding ourselves? Are we drafting off of the right people, so to speak? So social investing will always be with us. That's not going anywhere. I think it's been more dramatic in the recent past because of all the things that I talked about before, sort of the perfect tinderbox that the pandemic caused, but it's never going to go anywhere. So it's here to stay. So I think my advice to folks would just be to say, be thoughtful about the people and the messages you surround yourself with. Are you surrounding yourself with people who are trying to get rich the right way? Are you surrounding yourself with people who are intelligent and are lifting you and educating you and encouraging you to be smart and better with your money? Or are you surrounding yourself with a crowd who's, simply after a quick buck at any cost? Because it's an important maxim of finance that get rich quick and get poor quick are, sides of the same coin. The same activities, the same behaviors that will lead you to a quick buck will also lead you to a quick loss. And there's no telling which side of the coin you'll land on. So social investing is here to stay. It's hardwired into our DNA. It's facilitated by things like free trading and the ease of technology and the abundance of communication we have at our fingertips. So know this about yourself and surround yourself with the right sort of messages to make sure that you're drafting off the right race car, if you will.
Definitely. Love that. All right. I'm going to ask you kind of a heady question, Dan, just taking everything and really manifesting it, digesting it. So tell us about the future of society do you think society is going to become more community-based, or do you think it's going to become a little more individual, giving all these forces working together? I say that only because, we're talking about social investing. We're talking about the power of community. Yet I know that there's a separate movement of decentralization and the individual is more powerful than ever. So where do you see society going there?
So it's interesting because in many it's a great question, because in many respects we are more isolated than we've ever been. People live further from their hometowns than they ever have before. People marry much later than they ever have before. In some ways, we're as a country more independent than we've ever been before. Now, it's starting to boomerang a bit though, because even pre-COVID, we saw the UK and Japan both appointed governmental positions that were departments of loneliness, ministers of loneliness. And this sounds like it comes from an Orwellian nightmare, right? I mean, it sounds like it comes from some dystopian future, but this is where we find ourselves as a world is more disconnected than ever. And the research around that disconnection is powerful. Because research shows that being socially isolated is twice as damaging to your health as obesity. Loneliness is a better predictor of premature death than obesity. And the ill bodily effects of loneliness are equivalent to smoking 15 cigarettes a day. So social disconnectedness is very bad for us. So there's some positive things that are happening in psychology. We're getting, in the one sense, individualism has empowered us, but perhaps we've taken it a little bit too far. Perhaps we've over-indexed on individualism, and we've gone to the point of social disconnectedness now, and to the point where we're more apart than we should be. I'm optimistic that the lessons learned from COVID will swing us back in the other direction, right? I think everyone is really jonesing for a hug right now. Like everyone is really, everyone is really excited to be with people again. And I hope that the absence of connection has taught us some lessons about the power of connection. So I hope that in the future we can balance our needs for individualism and autonomy and self-determination with our needs to be connected to each other. And I hope that we can work as groups in smart ways as market participants, not necessarily to get rich quick, but to drive positive social movements. If you look at the civil rights movement in the American South, if you look at the end of apartheid in South Africa, both of these things were driven in a very, very literal and a very dramatic sense by people divesting of investing in things that weren't coincident, that didn't correspond with their morals. So I think there is a way for us to make powerful change in the world. And I think that voting with your dollars is one of the most powerful ways that we can do that. So I'm hopeful that the world in the future will balance the best of individual autonomy with social connectedness in a way that drives social outcomes by voting with our dollars.
Definitely. And Dan, I really felt what you just said. It was definitely a heady question. So thank you for humoring me there. But if I think about it, I feel like investors, I feel like we're moving more towards a collective society just because of COVID. And obviously social investing is a collective movement. But I also feel like investors are kind of leaning toward my investments show my individual identity. My stocks that I own are a representation of who I am and what I believe in. So there's just a lot of fascinating, trends and kind of tentacles going off of this phenomenon. And it's going to be really interesting to see, how the investors, especially investors of younger generations, really own this, how they own the markets and, how they own, this movement and, how they view everything.
Mm-hmm.
All right. So another heady question for you. And I'm going to ask you to kind of look in your crystal ball a little bit. So Dan, how do you think the social investing craze could change the future of markets? And I'm not talking about where markets are going because we have no idea, but how will the social investing craze change how markets look?
Well, I think it's going to introduce a lot of new folks to markets, which is nothing but a good thing. We know that there was a disproportionately large number of women and Black and brown people who were involved in investing in meme stocks. And hopefully, many of these folks were first-time market participants. And so hopefully, the whole meme stock movement and the awareness that it's driven will be an entree into financial markets for people who may not have otherwise shown up to the party. Because as Lule from Ally says, you just can't get there without being a market participant. We all have to keep up with inflation. Inflation's higher than it's been in decades, and we all have to participate in markets if we are to get there. And so it's an empowering thing, and I don't know that there's any going back from that. I think that the average investor is going to look different than they have historically. I think they're going to be younger than they have historically. I think they're going to be better informed than they have been historically, and all that is a positive trend. My fear is this. My fear is that people approach this in an undiversified manner that's too focused on quick wealth, and they are so concentrated that they're not able to learn the right lessons. So I think the opportunity here is that new market participants are getting educated, they're getting involved, and they're getting wealthy. That's nothing but a good thing. But I think we have to be careful that we do it in a smart enough way that these same people are not burned and don't become gun shy for future investing. So I see it as a huge opportunity if done in a sort of limited way, and if we do it in a diversified, smart way that allows us to keep tabs on markets, to learn about market action in a visceral way that'll really stick with us. And so that's my hope for the movement.
Definitely. Same here. All right. I think we have time for one quick question before we turn it over to the audience. So Dan, a little speed round for you. Okay. So if you remember, in our live poll, we had about 30% of people answered that they have traded meme stocks or that they are currently trading meme stocks. What is the message you want to send to somebody, well, an investor who's in meme stocks right now, really looking for guidance on, where to go, how to get out, how to make sense of this thing, and B, the investors who are watching on the outside saying, what the heck is going on and what does this mean for me?
Yeah, a couple of quick things. First is know your why. For a lot of people, maybe even most people, investing in meme stocks is going to have nothing to do with their why. Like, it's just not going to be on their financial roadmap. It's not necessary for them to do. So if this is inconsistent with your desires, if this is inconsistent with your financial plan, please don't feel like you have to get involved in something that is sort of outside of the domain of where you're headed. Right. So this may not make sense for most people or even many people. And then the last thing that I would say is, do it in a smart way. Do it in a way such that you only invest the money you can afford to lose so that you can learn the lessons you need to learn and live to fight another day.
Wise words. Love it, Daniel. All right, Brian, we've had a good conversation. I need a sip of water. So let's see what the audience is asking. Are we getting some good questions from viewers?
Yes, we have a ton of questions. And first one I have is from Jack. Top 5 tips on how to manage biases to help create better investing decisions in general. And I'll leave that. I guess I'll give that to you, Dr. Daniel.
Yeah, great question, Jack. I think I'll give you 3 that I think will cover 5, right? The first thing is, I think, to know thyself, right? To know yourself and to know that all of these biases apply to you. Overconfidence tends to be sort of the granddaddy of all biases, because until we realize that we are overconfident and that we are just as susceptible to this bias as the next person, we're not going to succeed. So see your financial journey as not only a financial journey, but a journey of self-discovery and getting to know about your own personality. And if you view it thusly, I think it'll be more fulfilling, and you'll learn some stuff that'll make you a better spouse, a better friend, a better neighbor, a better coworker, right? So learn about yourself and know that this applies to you. The second thing I would tell you to do is to automate. Automation is extremely powerful. We as a human race, one of our biases is that we're kind of lazy and we're kind of status quo prone, but that can be used for us or against us, because we're lazy to get started saving. We're lazy to get started investing. But if we can automate the program of taking that money out of our paycheck every 2 weeks, of escalating that contribution, every time we get a raise. If we can automate the process of diversifying our assets into the places they need to go, we can actually use our laziness and our status quo proneness in our favor. Automation will solve almost every behavioral bias all by itself. And then the third thing that I would say to you is to work with a professional. People who work with a professional tend to do about 3% better per year than those who do not. And it's, again, not because the professionals know the future, not because the professionals have a crystal ball. It's because the professionals keep you from blowing yourself up in March of 2020 when you want to panic and you want to leave the market. So know yourself, automate, get a pro, and you won't have to worry about every single bias under the sun.
All right. Okay. I'm going to send this next one back to Callie. I think Callie talked a little bit about it at the very beginning of this session, but what makes a stock a meme stock?
Ooh, that's a great question. And I'm sure everybody's definition is different. When I say meme stock, I'm just referring to the stocks that have been popular on social media boards, social media forums. Obviously, GameStop, AMC have been the ones that have really been in the headlines. But if you think about it, I mean, meme stocks, I feel like it's almost a pejorative term, so I hate using it, but that's the term that everybody's using. I feel like meme stocks could also too be considered, stocks that people invest in, with a cause or a nostalgia. Because if you look at like the GameStops, AMCs, BlackBerries, Nokias of the world, they all have some nostalgic feel to them, right? Like, okay, I'm almost 30, so AMC, theaters, GameStop, video games, BlackBerry. I mean, my friends had BlackBerries back in middle school or high school. It almost like conjures up feelings of the teenage years in a little bit. And I'm defining something that doesn't really have a definition, but the main meme stocks, GME, AMC, BlackBerry, Nokia. There are a few others that like caught the attention of like the social investing phenomenon. But there are a bunch of different ways to think about it. And I think it's interesting to consider, how meme stocks will be viewed from here on out, how these like social media targets with these nostalgic feels, or maybe social media targets that are being, favored by Wall Street or shorted by Wall Street, how they'll be viewed in an investment lens. So I know that's a little heady, but hopefully that helps out.
All right. So the next one comes from Marie. Dr. Crosby, do you believe in free will, and how does your belief impact how you approach investing?
Oh, Marie, this is a heck of a question. So I believe less in free will than when I started my studies of human behavior. So if we look at determinants of human behavior, the biggest determinant of human behavior is environment, right? Much more than our discretion, much more than our desires. People are usually about as good or as bad as the environment in which they place themselves. And so I believe in limited free will, but the way that should sort of operate with respect to what we're talking about today is making sure that you're surrounding yourself with the right people, the right ideas, and the right approaches, because we are much more impacted by our surroundings, by our relationships, and by the ideas that we put in our head than I think we would like to believe. study after study shows that people think they are much more in control of their behavior than they actually are. And in large part, we tend to be as good or as bad as the place in which we are standing. So make sure you're standing in the right place with the right people and the right ideas, and you'll be in good stead. That is an awesome question, Marie.
All right, I have another awesome question then. Is there a way to read how meme stocks will react in the market? Maybe like reading regular charts?
Ooh, I think this is mine. Good question. Good question. And honestly, it's tough to say. It's tough to say. So I'll rewind a little bit. So meme stocks, obviously GameStop was the target of a short squeeze. And if you think about short squeezes, it's where, a bunch of investors or maybe one investor has shorted the stock or bet that it'll fall. And they essentially do that by borrowing the shares from somebody else and then selling the shares in the open market and then hoping when they buy those shares back that they'll be able to buy them back at a lower price and sell them back at a higher price and essentially make that profit. So why did I say that? So short squeezes, the GameStop one was pretty extreme. GameStop rose to like $300 or $400. And it's really, really hard, when there are technical factors going on like that, and, there are a lot of people trading and the stocks are fast moving. It's really hard to find the center of gravity. And something unique about the meme stocks too, these GameStops, these AMCs, even I'll throw crypto in there too. Crypto, obviously not a meme stock, but it's a popular market for speculation. It's hard to find the center of gravity. It's hard to say these stocks should be worth X amount of money based on price, cash flows, based on sentiment, stuff like that. Even the technicals are hard to read when markets are moving so quickly. So it's hard to predict where they'll go. And that's why meme stock investing, you really have to be thoughtful about it. It's hard to catch the top. It's hard to buy in at the bottom. So I'm not sure I have any good advice or tips there. I would just be very, very careful. And, if you're gonna try to trade the price, figure out the price where you want to buy and sell beforehand, if you can get in there, just to avoid, some fear and some greed from creeping in. Say like, okay, if I want to play AMC, maybe I go in there and maybe I sell if the stock creeps above $20 or something like that. Or maybe I sell within 3 weeks. Try to define some limits when there aren't many fundamentals to go off of.
All right. I guess we have time for one last question. We have a good one here from David. David says, can Dr. Crosby comment on investing in social responsible companies versus profit-motivated investing, i.e., what percentage of people invest in social, environmental, responsible companies? And we have about 1 minute left, Dr. Dan.
So 1/3 of all dollars that are invested today are invested in a socially responsible manner. So that looks like different things to different people. What is valuable to one person may be anathema to someone else. So that's going to look different for different people, but it's something you're seeing more and more of. So I think that long-term socially responsible funds can keep pace with, but shouldn't be expected to exceed non-ESG or SRI funds. It's just something you want to do because you want to sleep well at night.
Excellent. All right. Well, that's going to be it for this session. What a great session. What a great discussion overall, just like all of them so far today. Next up, we have charts versus calculators, and we will start that session after another short 5-minute break.